Hi, hello everyone. Good evening. Welcome to ACCA FM webinar day 2. I hope you all are doing well. Kindly confirm, is my voice clear, audible to all of you, everyone? Kindly confirm in the chat box, please. Yes, okay. Thank you very much for the confirmation. I hope the first day of webinar went well for you people. Let's begin with very important, exciting day 2 of FM webinar, right? This is your instructor. This is about my profile. This is my 22nd FM webinar that I'm conducting today, and lots and lots of students managed to grab positions in these 3 papers that I teach. You have a good opportunity. Just follow the plans, and most likely, inshallah, you will be one of the position holders in your part of the world. All right, then. How to remain connected with me during the webinar. So this is the chat box where you will be sending a message, and I will be active with you people here. This is my number. You can see the number. You can see the number as well. And this is the number that you can use to contact me later on for any help, guidance, whatever you need. All right. So chat box is what we'll be using right now. The number is what I have shown you here. You can contact me. Now, those who will watch the webinar later on in form of recordings, they can contact these admission department for any help or support they need. Plus, be part of our global FM community. Be part of our global FM community. Join our global FM community groups. These will be very helpful from your exam perspective. So please, the link has been shared in the group by the team. Just join these groups for further help. Those who will watch these in form of recordings, make sure that you if you want to join the group, you can definitely ask the admission department the number I have shared here, and they will be more than happy to help you, more than happy to provide you the global FM groups. All right, then. So, guys, I hope everything is clear. Those who were part of the first day, I hope you enjoyed the first day session. Kindly confirm, uh, did the first day went well for all of you? Yes or no? Right. Very nice. Great. Okay. Now, I did mention last time about the revision batch. What is a revision batch? Those who are doing self-study, they can join our revision batch. This revision batch includes the top 20, 25 areas recorded content, which will be very, very useful for you people. And this recorded content will help you in preparing yourself for the examination. So please, those who are self-study students, do not waste your time. Just be in these revision camp batch, and you will get the access to all important 2025 areas, practice questions, and the recorded content for that as well. On top of it, you will be getting 2 mocks. One mock will be a live mock with live invigilation to be held, and we'll mark it. We'll give you the feedback for that mock as well. Number 2, there will be another complimentary mock with complimentary debrief that will be given to you. And for the first mock as well, there will be a debrief as well. That will be a live debrief. On top of it, what's next? So this will also include grand revision. Very important. Grand revision will be part of this batch as well, where I will be giving you a complete FM recap in 2 to 3 hours. Okay, so that definitely will be a very, very useful recap for you. I hope this is clear to all of you in terms of revision camp and everything. Those are those who are interested, they can contact the admission department. The number is given below. They can even they can even go to our website, and through the website as well, they can enroll themselves. You just have to go to the website and you can quickly enroll and get the access for this revision camp. Okay. Those who are part of the normal batch, the reset batch, you do not have to worry about these things. These are already well covered for you people. We will be giving a plan as well for you to follow, and this plan will include the recorded content planner and how you can cover on a daily basis. But I would advise the self-study students who will join this revision camp is to first focus on your weaker areas, things that uh, you are like you don't know about those things, you are not very sure about those areas. So it's better for you to cover those first. That will be more useful for you. And secondly, it will include the live classes like the webinars that I'm conducting today. I did that the day before yesterday. Plus there will be a live uh, grand revision to be held on 19th of April. Okay, 19th of April, this will be a grand revision, as I mentioned earlier. So you will be able to access that as well, followed by the mock to be held on 20th. Then there will be a detailed mock debrief on 23rd. Then we will provide you the results, and a complimentary mock will also be shared with you people. So this is the plan. Just follow it. Increase your chance of passing by joining the revision camp. By joining the revision camp. Okay. So I hope this is clear to all of you. Now, let's move on. So interested students quickly can contact the admission or the website. Today's topics, it's not changing. Today's topics include business finance, business valuation, if time permits, working capital. Okay, so we'll be covering these topics. We'll be doing a recap, then we'll move towards a new question. We'll solve the new question, and that will give you good confidence. Plus, there will be a focus on how to solve it properly and the exam techniques that I am always focusing on. So just give me a minute, please. Some technical glitch. The team is resolving it. Just give me maximum a minute, and we will then start with the revision of that. All right. So let's begin with business finance. Business finance is what we are starting first with. Uh, Business finance includes weighted average cost of capital as well. Now, what is business finance section about? This business finance section basically is a one that will deal with the different sources available to a company for raising the finance. That could be so many different sources of equity, that could be so many different sources of debt. So in this section you will learn about the different equity sources, different debt sources, what benefits they offer, and more importantly the cost of these different sources of finance. So when I say cost of these different sources of finance, so remember, if you go for equity, equity is not free for you. If you go for debt, debt is not free for you. If you go with preference shares, it's not free for you. So you have to bear the cost of these different finances, because as a company, when you raise these finances, you need to incur a cost. Now, what is important? What is important? If you are raising $100 equity, if you are raising $100 debt, so you have $200 altogether. Wherever you invest those $200, you have to make sure, you have to ensure that whatever the project is, wherever you have invested these $200, you should ensure that you cover the cost of those finances from that project. Wherever you have invested those $200, that project should be capable enough to cover the cost of these finances through which you have funded the project. Okay, so here we are at weighted average cost of capital, known as WACC. So a company who takes different sources of finance, uses different sources of finance, should determine the cost of equity if they are using equity, the cost of preference shares if they are raising preference shares, the cost of debt if they are raising debt. They should know the cost of these different finance options. And once you club those, once you work out the average of those, that is known as weighted average cost of capital. Now, this weighted average cost of capital is also known as WACC. And as I already told you, this represents the minimum rate of return which is required by the providers of finance. So let's have a quick look and recap how to work out cost of equity first. Now, when I say cost of equity, you have two very famous models to calculate cost of equity. One is dividend valuation model, and second is CAPM, capital asset pricing model. To be very honest about it, to be very blunt about it, CAPM offers a better KE estimate than DVM. If you ask me which is better, which is more practical from the market perspective, so I have no doubt about it in saying that it's CAPM. Now, a quick recap. DVM is a method to calculate cost of equity. There are two approaches. There are two formulas. One is without the dividend, without the growth perspective. Other is with the growth perspective, you work out cost of equity. When it comes to CAPM, my friends, it's more practical, it's more useful, it's more market related because it considers risk-free rate, because it covers overall market return, because it considers beta. Now, what is beta? Beta is a measure of risk. It's a measure of risk. The more the risk you take, the more the return CAPM will give. The less the return, the less the risk you take, the less the return CAPM will offer. So beta is a measure of risk. Now, what is the overall market beta? So the overall stock market beta is 1. So now any company having more than 1 beta means it is more risky compared to the stock market, requiring more return. And if it is less than 1, it simply means less return than the overall stock market. So yes, it considers market-based risk and return. When I say risk, so it covers the business risk, and it covers the financial risk of the company. What is business risk? That pertains to the nature of the business, whereas financial risk is the risk of debt. Now, then the other sources of finance cost calculation includes preference shares. Preference share is also a source of finance. You need to know how to work out cost of preference share. It does assume the same assumption of constant dividend like it was for the DVM. When it comes to debt, so you have options like bank loan, you have irredeemable debt, you have redeemable debt, you have convertible debt. So when it comes to the irredeemable, when it comes to bank loans are not tradable. In case of bank loans, there is a very simple formula to work out cost of debt. When it comes to irredeemable debt, so for irredeemable debt, there is a very simple formula, as you can see here, through which you work out cost of debt. Whereas for redeemable and convertible debt, you calculate on the basis of IRR, internal rate of return. You work out the cost of debt. But only one thing I need to add here, my friends, in case of convertible, you work out KD based on IRR. It's true to say you work out KD based on IRR, but remember, 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 there are certain steps to follow. And what is the step? In the last year, in the last year, uh, you will compare, you will take higher of value compared to the redemption, the cash option, and the conversion option, and then you will work out IR based on that. Now, one very important thing I want to tell you people here is, which is very important to remember, that in VAC, when you are at VAC, and this is not something we'll cover later on, today I'll show you a reverse possibility. I'll show you a mirror, which a reverse function. And what is that? I'll later on tell you. Right now, the perspective that you have to use is of a company. When I say whack, when I say whack, when I say whack, the next thing that should come in your mind is company. Say with me, everyone, right in the chat box. The next thing that you will think of is what? Company. I can still see nobody has written company in the chat box. I want people to write, respond quickly. Company. Now, what is a company? What I mean to say by a company is, the company is a one that is raising the finance, and when company is raising the finance, company is bearing the cost. So the cost perspective is a one that is with the company. So when I say WAC, so remember, WAC is a cost. WAC is a cost for the company. Yes, the perspective in WAC is that it's a cost for the company. So this is what you have to remember for now. We'll see what exactly this will mean later on. Now, how to work out WAC? What are the steps to work out WAC? It's very simple. First of all, we work out the cost of each source of finance. Let it be equity, let it be debt, preference shares, whatever it is. So we work out the cost of each source of finance. Once we have done the calculation of the cost, then we multiply those with the weights. Now, what weights actually mean? What do you mean by weights? Weights basically mean the market value or the book value, whatever you work out. So market value, book value is known as weights. Now, which is better? Which is more preferred? So remember, it's market value better than book value, because market value represents the current opportunity cost of finance. Market value is better than book value because in case of book value, you may understate, for example, the value of equity, because in book value, you consider the book values of equity. You do not consider the current market value, the current share price of that company. So this results in a situation where you may understate the value of equity, and once value of equity gets understated, my friends, remember, your WAC might be understated. And when your WAC gets understated, hello, when your WAC gets understated, you may end up taking wrong decisions based on overstated NPV. Very nicely said. Based on overstated NPV, because NPV and cost of capital has a inverse relationship. Just see me. Has a inverse relationship, which means as WAC goes up, NPV comes down, or as WAC goes down, NPV goes up. Okay. So yeah, coming back to step number 3, you multiply the weights with each source of each cost of each source of capital, and then you add all to work out WAC. So I did mention, guys, market value is preferred over book values. How to work out book value? It is very clearly written here. Ordinary share capital plus premium plus reserves. Whereas in case of market value, you work out using a simple formula, using their current market values in the market, like share price or value of debt. All right then. So after the recap, it's all set to start with the first question for today. Guys, certain tips, that's what I focus a lot. So number 1, complete in 36 minutes. And I did mention earlier that you have to make sure that you start with your strength area first. Remember, you perform the calculations in a very careful structure, clearly set out the workings. A spreadsheet is something that can save your ample amount of time. Ample amount of time. So just follow the basics of spreadsheets. For theory, yes, English should be normal, understandable, plus you have to make sure that you answer each and every object that is basically required in the requirement. So for theory, I did mention that we need to bifurcate we need to split the requirement into verbs and objects. Then we have to consider how many verbs, how many objects. Then we have to consider one more thing, and that is known as what? Very simple, very beautiful, very lovely. Is it knowledge based or application based? Okay. So keeping these tips in the mind, it's now time to begin with our first question for today. And here we go. Let's begin, everyone. Be with me. The scenario relates to three requirements. You know my basic SOP. I will read the requirement first. Calculate is the examinable verb. Market value WACC of B. This is the object. Marks are 10. So one verb, one object, 10 marks. This should be my strength area. From here, I can grab easy numbers. I have to make sure, because this is a 20-mark question. To pass this question, minimum how much I need? Come on, can you tell me, please? The minimum that I need to pass in this question is how much? You're not replying, yaar. You're not replying. You're a boring audience. 10. And to make sure that I reach to 10 first, I will target this first requirement. Will try to grab maybe 7, maybe 8 marks. So automatically my chance of passing will increase in this question. Okay? Because I haven't seen the next two requirements, maybe next one, maybe two, but it seems those are theoretical related. Yes. Discuss is the examinable verb. What to discuss, man? Why? Why? Market value WACC is preferred to book value WACC when making investment decision. So this is the object. Discuss was the verb, and this is the object. We'll come to this later on to see what needs to be done. Next, discuss is another verb I have here. What to discuss? 3 attractions. These are not attractions that you think when you're going outside your country for recreational activities, okay, for vacation. So 3 attractions. These are not those attractions. 3 attractions to B company of convertible debt compared to bank loan of a similar maturity as a source of finance is what you have to write here for 6 marks. We'll come back to these later on. Let's start with reading of the question. The statement of financial position of B company includes following information. I've already made this clear so many times in my lectures. I'm again repeating here. Remember, remember, remember. What to remember? Remember, whenever you are dealing with a WACC question, just look at the balance sheet, extract to figure out very quickly the sources of finance that the company is using. So here we have equity as a first source of finance. Then we have non-current liabilities. Under this, we have 7% convertible loan note as a second source of finance. And we have 5% preference shares as a third source of finance. So once you are able to figure out the different sources of finance available in the balance sheet extract, you clearly know that you have to do the workings for 3 sources of finance. You need to work out cost of equity here. You have to work out cost of convertible loan notes, and you need to work out the cost of preference shares. Okay. But for that to happen, it is extremely important that you need to make sure, you need to ensure, you need to figure out that which methods are you following to calculate it. So by looking at the information, it will be very clear that which methods are we using here. First of all, I'll read for cost of equity. It says the company has an equity beta of 1.3. I'll underline all sort of numbers, percentages. The ex dividend market value of the company is 80 million. Now, what is ex dividend market value of the company? So, remember, what they have given you is a market value of equity. Total market value of equity is given to you 80 million. Okay. The ex interest market value of convertible loan note is 18 million. Very nice. Again, this is what? This is the market value. This is what you need to figure out in the mind. Market value of convertible loan notes is 18 million, and the ex-dividend market value of irredeemable preference shares, irredeemable, okay, is 5.5 million. So if you are a student of financial management, you should figure out that they have given you 3 total market values. What? 3 total market values are given to you. 1 for equity, 1 for preference shares, and 1 for convertible debt. Okay. The convertible loan notes of B have a conversion ratio of 20 ordinary shares per loan note. Okay. Redeemable at par. The conversion date, okay, they are redeemable at par. So, yeah, either they are converted into 20 ordinary shares per loan note, or they will be redeemed at par value. The conversion and the redemption both are at the same date in 5 years' time. So, it is at the same time. The current ordinary share price of the company is expected to increase by 4% per year. All right? For the foreseeable future. Done? The equity risk premium is 5% per year, and the risk-free rate is 3.5% per year. The company pays profit tax at an annual rate of 20%. Done? Very nice. Lovely. Beautiful. Let's begin then. Guys, are you all with me? Okay. So first I'll start with the cost side, which includes number 1, cost of equity. Second, cost of preference shares. Then cost of debt. Cost of equity, which method you think is useful here, that you have to figure out on your own. One is CAPM, one is DVM. Which one you think is applicable here? CAPM. Very naughty. So the equity risk premium is 0.05 plus, sorry, I beg your pardon. Risk-free rate is 0.035 plus equity risk premium. Now, what is equity risk premium? Equity risk premium is RM minus RF, RM minus RF of 0.05 multiplied by beta. Do they have any beta value here? Yes. 1.3. Guys, can you see the workings? Is the working clear to you, all of you? Say yes or no. Okay, so risk-free rate plus equity risk premium into beta. And you will get a percentage of 10%. Very nice. 1 mark in your bucket. You need to pass in this question. You need minimum 5 marks. So 1 mark in your bucket. Congratulations. I hope no problem in this working. Now, preference shares. Preference share calculation is done how? On the basis of preference dividend, which is 5% here. You will apply this 5% on the nominal value, and the nominal value by default is 1 here. Okay, so you will apply this on nominal value, which again will give you 0.5, 0.05. You will divide this with the, what we use? Share price. Share price of preference shares. Do we have share price of preference shares? This is the nominal value. We don't have. Yes, here it is. Market value of preference share is 5.5 million. Now, this is the total market value. And what I need? Say something, yaar. What I need is 5.5 okay for me? I need per share value. Yes, per share value. So again, $0.05 into 1. Okay. So divided by 5.5 million is the total preference shares market value. I need for each share. So I'll divide this with the number of preference shares. Now, how many are the preference shares? 10 million. Because in the balance sheet, you can see preference share capital is 10 million and the par value is 1. So number of shares would be how much? 10 million. So this calculation, 5.5 divided by 10 million is giving me per preference shares market value. One market value of 1 preference shares. Done, everyone? Done. So I'll convert this into percentage. Okay. This is the calculation of cost of equity, risk-free rate plus equity risk premium into beta. Okay. This is KE calculation I've done. And this is preference share dividend into nominal value divided by market value of each preference shares. KD. For KD, what we need to do? For KD, we need to work out IRR. For IRR, what we need to do? For IRR, we need to just make a working area and refer to W1. And here I have the working area. I have the working area. Now we have the working area here. Hello, everyone. Hello, everyone. So what we need to do here? Very simple. Very simple. Through shortcut, through IRR function, I'll work out. Year 0, year 1, year 2, year 3, year 4, year 5. It's 5 years bond, right? Okay. In year 0, we'll take the market value of this convertible bond. But unfortunately, I don't have the market value. What I have is total market value. What I need is market value per bond. What I have is total market value. What I need is market value per bond. So total value is 18 million. Okay, 18 million, right? 18 million. Now, how to come to the market value per bond? Guys, do you remember what needs to be done? Yes. Yes. So, how we used to work out the market value, total market value formula. Do you remember the formula? Let me just tell you quickly. The formula was nominal value divided by nominal value per bond multiplied by market value per bond. Was that the way to work out the total market value? Say something, bhai. Everyone, say something. Yes. So just work back. Just work back to find out the market value per bond. Just work back. Okay? Done, everyone? Clear? So can you tell me what is the market value you are getting in this case? Okay. Yes, 90. Correct. 90. Right, everyone? Are we clear? So 80 divided by 0.2. Oh, 18 divided by 0.2. Okay. So 90 is the market value per convertible debt. We have to show this in negative form. Okay. So here it is. 18 is the total market value. Divide by 0.2. What is 0.2? Very simple. It's the convertible loan notes, 20 million divided by nominal value of 100. Okay? Done, everyone? Done. Now, the coupon rate is 7%. Should we take after tax or before tax? Sir, after tax. After tax. Okay, okay, okay. Okay, don't be hyper. Let's take it after tax. 1 minus, what is the tax rate? What is the tax rate? Can anyone tell me please the tax rate? Tax rate is 20%. Okay. So 1 minus tax rate is equals to okay 5.6. Year 2 5.6. Year 3 5.6. Year 4 5.6. Now in the last year, higher of between cash and conversion. Okay. So redemption, if you go with redemption will be at par, 100. And if you convert it if you convert it, so each will be converted into how many? How many? 20 ordinary shares. Right. 20 ordinary shares. Now, what is the current share price? We don't have share price. Do we have? We have one thing. We have current market value of equity. Total market value of equity. What we don't have? Share price. Now what to do? Now what to do? We don't have share price. Any idea? Any idea what to do? Yes, we have an idea. You can work out the share price. Do you have shares? Yes, we have shares. 20 million is the ordinary share capital. Having a par value of 1 means 20 million shares. Okay? So, share price 20 80 divided by 20. What is the share price, everyone? 4. 4. Okay. So what is the share price right now? 4. Now, will you grow this share price? Yes. By the growth rate which is given to us, 4%, 1.04 power. How many years? This will be converted into equity after 5 years. So power 5. The current share price is 4. Current share price is 4. I will grow this by 4% for the next 5 years. I will grow this by 4% for the next 5 years. Nothing happened because I have to multiply this. Okay? Done? So this is my share price, 4.87. Okay? Now, this will be converted into how many shares? 20. So 20 into 4.87. What will be the conversion value? The conversion value will be 97. Very bad. 97. So which is higher of? Higher of is 100. Higher of is 100. Got it? Done. So we'll take 100 here. In the last year, we'll take 100. So very simple. Interest plus higher of interest plus higher of interest plus higher of. Done. Now the magic IRR function. IRR 0, 1, 2, 3, 4, 5, 0, 1, 2, 3, 4, 5, 0, 1, 2, 3, 4, 5. Are you with me? Done. Say something. IRR C10, C15. IRR C10, C15. So what is the answer? The answer is two decimal places in terms of percentage. 8 point, no, is it 8.11? Yeah, 8.11 is okay. Done, everyone? Are we clear? Any problem? Okay? Great. Done. So I think that's okay. We have the answer. We'll refer here. 8.11. Done. So we are done with the cost part. Cost part done. Now value, 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 market value of equity, which is not at all difficult because they've already done it. They already have done it. How did you calculate to get 5.6? I've done a very big magic, and the magic is here. This is the magic. 7, 1 minus tax rate, okay? Done. So what is the market value of equity? 80. What is the market value of preferences? 5.5. What is the market value of debt? Convertible debt? 18 million. You can take 2 decimals, 1 decimal, doesn't matter, okay? You can just mention your decimal policy. Is this clear to all of you? It should be. It should be. Okay. Now, once we have the value, once we have the cost, we will multiply cost with the value. 80 into 10, next 5.5 into KP, 18 into, I know I'm not a very good singer, so you just have to bear with me, okay? Bear with me. Done. Now, let's add up the total market value of equity, market value, market value of capital employed. Yeah. Market value of capital employed. Don't do buttering, okay? I don't like buttering. I know I'm not good. So market value of capital employed. If you are doing buttering, it won't pass you. Everyone with me. Yeah, we can use that proxy. Yes, correct, Talha. We can. We can. We can. Okay. Now, what is the WACC? The WACC is the WACC is the WACC is 9.6, 9.6, 9.6. Okay, everyone, clear? Done. So the calculation, though the calculation is 9.6 WACC. Okay. Do you have any questions? Enjoying? Yes, no? You can express your feelings here, okay? As for the marking scheme, you are getting marks for everything you have done. CAPM, 1 mark, preference shares, KP, 2 marks, KD, generally in KD you get 3 marks, okay? Maybe sometimes 4 marks for KD. KD is a valuable marking area because it's convertible, so you need to work out IRR, so you may get 4 to 5 marks. Then WACC, final calculations, 2 marks. Conversion part again. Okay, bhai, I'll do it. That's my work. But please just tell me what you want me to explain. Don't say explain everything. Okay. Conversion part you said, right? Okay, here it is, the conversion part. So you can see the share price was not given. So we worked out share price first. Market value of equity was 80 divided by 20 million shares will give you share price. Then we will calculate the share price after 5 years by applying the growth rate for the next 5 years. Then I worked out the conversion value, multiplying this with 20 shares, and then I compared that with the cash option to decide which is higher off. Okay? Done. So I have repeated this again. Now, I think we are done with this first 10 mark. Now the next 4 marks. What I mentioned you to handle theory. What is my plan that you have to follow to solve theory is very simple. And what is that? First, find out verb. Verb is, don't need to write in the paper, okay? Discuss. What to discuss? The object. What is the object? Why? Why? Market value WACC, okay, is preferred. Is preferred to book value. Khalas. The next question you have to ask yourself, which question type this is? Knowledge based, application based, and it is very clear that this is knowledge based because nothing given as a sign to connect with the scenario. Done, done. Okay, perfect. Now, it's a knowledge based question, so let's focus on the reason, right? Market value WACC is more preferred to book value WACC because they are asking why. My reply is because. They are asking why. My reply is because. Somebody asks you why. You say because. It reflects the current opportunity cost of finance. Okay, done. Further, because look at the verb. Verb tells you the intensity of the discussion. It does not state, discuss. So you have to tell why it is preferred. You have to discuss this completely by mentioning that number one, it represents the current opportunity cost of finance. Now, how it will be beneficial? Okay. So, using book values, okay. For example, in case of equity, the book value will understate the VAC, which further will overstate the NPV. As equity, you all know, it's a truth that I'm writing right now. As you all know, equity represents is major source of capital. So any understatement means WACC will be affected. WACC will be affected. Okay? So such overstated NPV might result in wrong investment decisions for the company. Okay? I hope this is clear to all of you. You have seen how to draft in form of a paragraph, everyone. Yes or no? Clear? See, opportunity cost in simple words, if you want to understand, you can just keep it in your mind that market value represents the current value of the company's capital. Current market value of the company's capital. Okay? Simple. All right, everyone. So why MV is preferred over BV? Because MV represents current cost of finance, which means it will not understate WACC and hence overstate NPV and will not result in wrong decisions. Right? If you look at the marking scheme, mentioning about market value, book value earns you 1 mark to 2 mark approximately. Okay? Plus, why preferable? The reason that you mentioned will give you 2 marks, like overall what I've made the case here, why it is preferable. Okay? So mentioning about market value, book value, why it is preferable, you can expect 4 marks like this. 1 mark for mentioning the market value impact, the book value impact, and the reason why it is preferred would approximately have 1 to 2 marks. Right? Clear? Okay, next. Hello, next. Are you with me, everyone? Say yes or no. Now, the next question. Let's do the same planning work. The verb is discuss. The object is, I don't know. Let's read. 3 attractions of going to Turkey, 3 attractions of going to Mauritius, 3 attractions of going to UK. If somebody says 3, so please control yourself and just mention 3. So 3 attractions of using convertible debt over bank loan, as a source of finance. Okay? 3 attractions. Now, please, one thing. What type of question you think this is? Is it knowledge based or application based? Sir, application. How? Because they have used the word Banbury company, blueberry company, Banbury company. So they have used this word. So yeah, this is application based. Okay. Done. Now, 3 attractions. Why convertible is better than the bank loan? Positives of convertible. What are the positives? And remember, let me tell you one thing. Let's write the positives first. Lower interest rates. Positive number 1. What else? Security for debt. What is the third one? Security for debt. Third is very simple. Impact on gearing. What else? Avoiding negative uh, a shareholder perception. What is the next one? Possibility of not redeeming the debt at maturity. So many. Just 3. Okay, just 3. I'll confine myself to 3. Now listen. If you mention this only, you get this only. To get this only, you need to look at the verb only. So if you look at the verb only, it says discuss. So look at the marks. Marks are 6. Points are 3. Remember the school days. 6 divided by 3. 2 marks per point. 2 marks per point. Under this heading, you can use headings. Write in form of paragraph why this is a benefit of convertible debt. So, because I have to link with Banbury, so when they ask you to link with the exam scenario, if you see some healthy information available to be linked, you should link it. Any scenario, any points to attach with, but sometimes you don't find those points in FM paper, but they still use the name of the scenario. It seems to be like an application based question. So what to do? Play a trick. What is the trick? The minimum level of linking, if nothing is available, the minimum level of linking is, if nothing is available, is to use the name of the scenario. Wow. So that you look like a family member of the examiner. You have to become his family member, okay? So Banbury, lenders in case of convertible bond will be willing to charge lower interest rate from whom? From B company. Why? 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 Reason? You won't get marks for this only. No, 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 no. Tell the reason why they will charge lower interest rate. Because of additional value offered through conversion rights. The conversion right that has been given to them. The conversion right. Wow. Conversion right. They are giving us the importance. They are giving us the importance that if we want to become the company's shareholder, we may. Okay? Very nice. So to get the marks completely too, you need to mention the reason, bhaiya. Varna means otherwise. I'll teach you some Urdu Hindi as well. Varna means otherwise. You won't, and bhaiya means brother, okay? Brother. So you won't get the marks. Done. Very nice. Beautiful. Next, security for the debt. In case of convertible debt, B company may not have to offer assets as security, again due to value added component of conversion that might not be the case for bank loan. Okay, right? Done. Are you with me? Yes. Impact on gearing. Do you think it will have a positive impact on gearing? Yes. Yes. Okay. Not at the first stage. Yeah. Initially, both convertible debt and bank loan will increase the gearing of the company. Okay. However, at a later stage, when the lender exercise the right to convert into equity, it is when gearing will reduce. For whom? B को. भाई mention the name of B को. Minimum mention the name of B को. Play with the examiner. B को. Okay? As debt will be converted into equity. Khalas. Khalas, everyone. Are you with me? Say yes or no. So you need to link with BICO. It's very important because it's application based and sometimes you don't see any sort of a link. The best way to link is to look at what? Is to look at what? Is to consider what? Tell me. Nothing. The name of the scenario. You should use the name of the scenario. Okay? Done? Clear? So we are done with this one. I hope no problems, everyone. Khalas. Business valuation. Next area. Now it's inverse of WACC. Very interesting. I like this personally. Business valuation is inverse of WACC. Now why I am saying this? Why? Let me explain you. When you were dealing with WACC, so your mindset was for a company, okay? Company, and you were calculating the cost for the company. Is that right, everyone? Yes? You were calculating cost for the company. And remember, don't tell anyone, when company will pay interest, because I now am targeting interest here, okay? So when company will pay interest on its debt, interest cost, okay? So in that case, interest is tax allowable for the company. So on this interest, company will enjoy a tax benefit, okay, because it's tax allowable. So company will reduce its interest cost. So the KD will be net of tax. Let's suppose the interest is 10 and you will get a tax relief on the interest of, let's suppose, 20%. So if you do it 10, 1 minus tax, you know this calculation, okay? So your cost comes back to 8 because interest is an allowable expense for the company. And this will always be post-tax. All right. Now, remember, KD is always after tax. KD is always after tax. Always after tax. Always after tax. Okay? Because the perspective is of a company. And for company, interest is a tax allowable expense. But when we come to business valuation, so let me introduce business valuation to you people. Business valuation will teach you how to value a business, which includes valuing equity, preference shares, and debt. Okay? Whether it is equity or preference share or debt, you need to take into account the perspective of investor. Investor. In VAC, the perspective that we take is of a company who is using the funds. In business valuation, we'll consider the impact of lender who is providing the funds. Because who is providing you the funds? Owner, lender. Who is the owner of those funds? Owner, lender. So who is in the best position to determine the worth of those funds? Lender, owner. If you have a car and you are the owner of that car, you are the best person to determine its value because you are the owner. Similarly, if lender is the provider of finance, he is in the best position to tell you the value of that. So here, to calculate the value of a share price for equity, investor perspective. If you have to value the share price of a preference shares, investor's perspective. And if you want to value the debt, so investor's perspective. So calculating all sorts of market price, whether it is equity, whether it is debt, whether it is preference shares, who is in the best position? Investor, owner. So in business valuation, we consider the perspective of investor. Are you with me? Say yes or no. Okay. Because of this change in mindset, equity has no problem. Preference shares also has no issue. The problem comes here in case of debt. In case of debt. Because in case of debt, interest that the company pays, on that interest company receives the tax benefit, and that tax benefit reduces the cost of the company. So if a company has paid 10 interest, the cost for them is 8. But here the twist is, that 10 interest cost is paid by the company to whom? Lender, owner of the funds, lender of the funds. So how much the lender receives? Is it 10 or 8? 10. 10. Lender receives 10. For owner, the net cost is 8 because owner is getting a $2 benefit on that interest. So for company, for user. For company, the cost goes to 10. Yeah. For user, company, the cost goes to 8. For company, the cost goes to 8. But for lender, the return is 10. The return is 10, which means this return is represented by R, and this is always before tax. So the investor return is R before tax, whereas company cost is after tax. This is one of the most important concepts, and you need to understand this transition when you're moving from WACC to valuation. So my friends, going back to this slide, it is important to differentiate between KD and R because R is return of the investor. This is before tax, and KD is a cost to the company which is after tax. So in business valuation, the perspective is of, come on, say something. Perspective is of owner. So we'll always use R before tax. In WACC, we always use KD because it's the company perspective, which is after tax. Khalas. Done, everyone? Okay? So the difference is clear. In WACC, KD after tax. In business valuation, R before tax, return for debt. Now, let's start with equity. How to calculate the share price? There are different options. Discounted cash flow, in which we calculate the present value of the cash flows if there is a defined period, defined life of that project or a company. If it is an indefinite life, we use perpetuity factor to work out the present value, but the concept is to work out the present value of the cash flows. Khalas. DGM, you did saw in WACC as well, dividend valuation model. But when you were at WACC, you were calculating cost of equity because it was company's perspective and the share price was given to you. But now when you are at business valuation, so you are calculating share price and the KE will be given. So in business valuation, share price is what you're working out and cost of equity will be given to you. In WACC, cost of equity was required to be worked out and share price was given to you. So anybody wants to differentiate, is this question of business valuation or WACC? The basic simple thing is, if they ask you to work out KE, then share price is given. This is WACC. If they ask you to work out share price, KE will be given to you. And this is valuation. Khalas. Done. Other group through which you can work out the share price, because there are three groups: cash base, asset base, income base. So in income base, you have PE ratio, earning yield as a method to work out share price. Are you with me, everyone? Yes, we are with you. Thank you. So the formula here is earning per share into PE ratio. Price earning ratio is a very good ratio to work out the share price. So here you use the EPS, earning per share, of target company. Target company means the one that you want to acquire, and you use PE ratio of proxy. Now, what is proxy? The target company that you want to acquire, the industry in which that target company is working. So you use the P ratio of that industry, or you use PE ratio of that target company's competitor. What I said? Competitor. Okay? So this is how you work out the share price. Similarly, for earning yield, EPS of target company, whereas earning yield of the proxy. And when I say proxy, it's the same rule. What's the same rule? The rule is, say or something, industry average or competitor earning yield. Blocked. Okay? Done? So this is earning based valuation method. Other valuations that you have to learn, and everything will be reversed. When you were at VAC, the focus was on KEs, KDs, KPs. So now we are in the reverse world. We can see the mirror now. So when you were at VAC, it was KE, now share price. When you were at VAC, it was KP, but now it's share price. This KP will be given to you, my friends. Share price is what you need to find out. See, the change in the mindset, the change in the perspective. People get confused. I see on social media different comments. We are not sure. Sometimes they say workout P naught share price. Sometimes they say workout KP. Oh, bhaiya, it's so simple. Bhaiya means brother, okay? It's so simple. When they say workout P naught, it means share price for preference shares, and KP will be given to you. If they say workout KP, share price will be given to you because that is VAC. For debt, we just saw few moments before, not later, that there was redeemable, irredeemable, convertible. So in case of redeemable, irredeemable, convertible, we worked out how to work out cost of debt after tax. Here we will work out how to value these. So we'll work out market value of these. So for market value, remember, if it is redeemable, so the method is present value of interest plus nominal amount. If it is convertible, so the method is same, present value of interest plus higher of. Same thing, higher of between redemption amount and conversion amount. Okay? And when it is about irredeemable, so the formula is I divided by KD. But remember, this is KD. After tax or before tax? Come on. This is before tax. Okay? Before tax. So, when they ask you to work out market values of debts, what should come to your mind? Say, yaar, business valuation. Say with me, business valuation. And for sure, what will be given to you? KDs. What sort of KDs you need? Before tax, after tax. By default, for sure, 100% you need before tax. Khalas. Happy? Not happy? Is the revision going good? A quick revision of both the areas. Say something, yaar, yes or no? Very nice. Very, very nice. Hello. Great. Some important tips for section B before moving towards the question. The first is it's a scenario based session. MTQs are scenario based. So make sure that you do respect the scenario. The people who are struggling in section B, the biggest problem for them is they do not relate with the scenario. Okay. Make sure your rounding of instructions are completely in your mind and you round off it properly. Make sure to complete this within 18 minutes. The best way to do it, start with the easy MTQ first. And in that MTQ, start with the easy OTs first. Because you can grab quick marks with less time. Plus, it will allow you to complete in 18 minutes. What a technique! What a technique. Remember, to pass in one MTQ, 6 marks you need. 3 OTs. In that, easy ones will give you marks very quickly. Remember, if you grab 6, 6 and 6, you end up getting 18 out of 30 and you pass in section B. Khalas. Okay? Understood, everyone? Say yes or no. Very nice. Lovely. Excellent. All right then. Let's begin. With the question. Let's read the scenario. G company is a listed company. So it is important because we are solving a question of business valuation, and in valuation, listed and unlisted is important to consider. With a cost of equity of 12%, KE is given to me, KE is given to me, which plans to achieve a dividend growth of 5% per year. 5% per year. Gen Z, are you with me? I don't know whether I have just Gen Zs with me or millennials as well. Okay, 5% for the foreseeable future. G company operates in an industry with average PE ratio, industry PE ratio of 12.5 times. Come on, just let me know how many Gen Zs are here or millennials are here. In the chat box, please quickly respond. Let's see. Z. We have first Z, M. So it's a good competition of Z's and M's. Come on, everybody should respond. Let's see who wins. So we have more Z's here than M. These Z's are difficult, to handle than M's. Okay, the ordinary shares of the company have a nominal value of 0.5 per share. So I'm also M, okay. No, I'm a Z. I'm also Z, okay. Z, one more added into the list of Z. So you lost M. Extract from the financial position, the company are as follows. Operating profit 345, interest expense, PBIT, taxation, profit for the year, ordinary dividends and retained profits. You can see the extract of balance sheet as well. The long-term borrowing consists of 7% loan notes, which are redeemable in 7 years' time at a premium of 5%. Okay, to their nominal value of 100 per loan note. The profit before tax, KD before tax, KD before tax is 5% per year. Very nice. And after tax cost of debt is 4% per year. So let's begin with the first one and let's see what we need to do. The first question, what is the value of G company using PE ratio method of valuation? PE ratio method of valuation. Okay? All right. So, what are we using here as a method? Price earning ratio method. So, what is the formula? Guys, what is the formula? The formula is pretty clear, simple, and that formula is, come on, any idea? EPS into price earning ratio. Okay, EPS, price earning ratio. So for price earning ratio, what option do we have? We can use the proxy PE ratio of 12.5 times, okay? Right? Proxy. All right. What about EPS? So the EPS that we have to use here is, all right, where is EPS? We have to take EPS of G company, okay? So profit for the year is given to me, which is 264 million. And they want me to work out the value of the company. Now it's up to me. Either I can use earning per share to work out share price and then multiply again with the number of shares to get the share value, the value of the company. Or I can directly use earning per share. I can directly use earnings total here. So I have to save time because this is section B. So rather than converting this into EPS, I'll use total earnings of 264. Okay? So that I can work out the total value, and that value will be 3,300. Is that right? 3,300 in terms of million. Are you with me? Yes or no? Yes. Okay? Yes. So it's very straightforward. Proxy PE ratio, target company EPS. Instead of EPS, I took total earnings. I'll get the total value. Is that right, everyone? Say yes or no. Done? Okay. Next. The next question. What is the value of one share? One share. It's very clearly written here. Value of one share in G company using DVM, dividend valuation model. So when it comes to DVM, the formula to work out share price is, you know its share price. It's D1 divided by KE minus growth rate. Is that true, everyone? Yes or no? Arey bhaiya, say something. Yes. So what is my D1? My current dividend is 160. Okay, 160. And this dividend is based on how many shares? This is based on a share capital. This is share capital of 100, okay? Million. What is the par value? So do we have any par value? Do we have any par value given here? 0.5. Right. So what I can do, I can first of all work out the number of shares. 100 million divided by 0.5 will give you 200 shares for equity. Correct, everyone? Yes? Correct? Correct. Now, the dividend that we just paid was 160. So, this dividend of 160, if I divide with 200 shares, will give me dividend per share. Are you with me, guys? Yes, say yes or no. This is dividend per share. I will multiply this with the growth rate if it is a growth question. So are we given with dividend growth? Yes, 5%. Multiply with 1.05 to make this D1 divided by KE minus growth rate. Cost of equity is 12%. 0.12 minus dividend of 0.05, the growth rate I'm talking about. This will give you share price of $20. Khalas. Are you with me, everyone? Say yes or no. Done? Perfect? Nice? Great. Lovely. Fantastic. Okay. So the answer is 12. You have seen the calcs. Very easily manageable, keeping in mind the coverage you guys have done, nothing special needed. Okay, next. What is the market value of loan notes? Market value of what? Loan notes of G company. So what kind of loan note are they talking about? Here you go. They have a loan note having 7% as the coupon rate, and this is a redeemable loan note that will be redeemed in 7 years' time at 5% premium. Okay? So now, what to do here for a redeemable market value bond calculation? And mind you, the question here says market value of loan notes, which means it is not market value of each bond they are talking about. It's the total market value they are talking about. Are you with me? You should be, okay? So if that is the case, let's go here. Let's see what I can do. Years, cash flows, discount factor, present value. Okay? Now, interest plus redemption amount. Okay, for interest, what I need to do? 7% is the coupon rate. So this will be for 7 years. 7% into 100 is 7. I want to ask you one thing. I want to take a permission from you guys in relation to one thing. Should I make this interest after tax, or let me keep this before tax for you? Yes, before, because this is a question of business valuation where you are calculating the market value. Very nice. Now, in the 7th year, this would be redeemed at premium of 5% to make this 105. Is that right? Okay. Now it's time to discount it. So for discounting purpose, what is needed? We will discount at KD. Now which KD should I take here? 4% after tax or 5% before tax? Come on, you tell me. Sir, this is a business valuation question and we need to work out the market value of bond. So we'll take before tax KD of 5%. Yes, known as R. So let's work out 7 years annuity factor. 7 years annuity factor. So 7 years annuity factor value is how much, guys? 5.786. Okay? And you get the value here. Multiplied by single discount factor of 0.711. You get the value here. Okay? You will add these two together and you will get a value of 115.16 per bond. Now this is the market value per bond. Now this is not the answer. The answer will be when you will multiply this with the number of loan notes. So let's do it. Total loan note value is given in the balance sheet, and that is 200. No, that's current. That is 300. Okay, 300 is the value given here. 300. So total nominal value, okay, divided by nominal value per bond into market value per bond, and the answer is 345.5 million. Khalas. Okay, done? Clear? So I hope no problems as far as this is concerned. The answer is 345.5. Now we are done with this question as well. Next. Which of the following statements about noise traders is or are correct? Now this is always important. I always say you need to determine is on R thing here. Okay. Why I say this? Because maybe one correct statement, maybe two. Okay. So they generally underreact to good and bad news. Now, what do you think? Who are noise traders? Noise traders do not make any rational decisions. Okay? And noise traders underreact? No, overreact. Yes, they overreact to a good news. If there is a news, they are like, okay, everything is going good, do it, do it, do it. They overreact to good news. They overreact to bad news. The word underreact is wrong. It's overreact. So this is not correct. With me? Not with me. Not with me? Okay. So this is false. Second, they make rational decisions based on fundamental data. Do they make rational decisions? No. They do not use fundamental data. They do not make rational decisions. Okay? So they make uninformed decisions, which means neither one nor two is correct. Both the statements are wrong. Got it? This question is testing your concepts. That what do you mean by noise trader? Right? Done. Next, which of the following statements are correct? Are correct. Equity finance reserves represents the cash which is available to a company to invest. Guys, what do you think? Equity finance reserves, share premium, other reserves, retained earnings, whatever you have, is that equivalent to cash? Are they cash form reserves? These are profits. These are profits. Okay, these are not cash based reserves. These are profits. Okay, so this is not correct. Not correct. Right? Are you with me? Okay, because you pay dividends using cash. Okay, whatever investment you do, you look at the cash. Maybe you might have large reserves, but less cash. Okay, wrong. Earning per share. Earning per share is unsuitable way. Unsuitable. The word is unsuitable. Way of assessing financial performance against G company's competitors. Now, if you want to gauge the performance, who is going good, you or the competitor? If you want to check the performance, who is going good, you or the competitor? So EPS is not a suitable measure. Is this true? Yes, this is true. EPS is not a good measure because EPS is dependent on shares. What is the formula of EPS? Earnings divided by shares. So more shares, EPS will be lower. Less shares, EPS will be higher. Okay. So no, the better is PE ratio. PE ratio is a good indicator to judge the performance of the companies. The company having higher PE ratio will be more attractive in the eyes of investors. Okay, this is wrong. Oh, this is correct because it says unsuitable. Third, scrip dividends. Scrip dividend, you know what is scrip dividend? Yeah, dividends that you pay in form of shares. Instead of cash, you pay shares as dividend. You issue more shares, and that is done against share premium or retained earnings. Come on, tell me. Retained earnings. You use retained earnings for it. Okay. So scrip dividend decreases liquidity of shares by retaining cash in the company. Liquidity of the company, they are not saying. They are saying liquidity of shares. Now, liquidity of share means what? How easily shares are sellable. It depends on the share price. It depends on the share price. So the lower the share price, more easy it is to sell and buy the shares. The more tradable they are. Are you with me? No? Yeah. So when you issue more number of shares, I repeat, when you issue more number of shares for the sake of paying the dividend, this means what? More shares will be issued in the market. When more shares are issued in the market, share price goes down. And once share price goes down, the shares are more liquidable. There will be more liquidity of the shares. So the answer is, this is wrong. Scrip dividend increases the liquidity of shares because more shares are issued in the market, the share price goes down and they are considered more tradable. Okay? Clear? So this is false. So the answer is 2 only. I hope this is clear to all of you as far as this is concerned. Yes, everyone? Done? Done. Very nice. Okay. All right then. Let's start with the revision of working capital. Enjoying everyone? Quick revisions, practice, revision, practice. Yes? Now, working capital is a difference between current asset and current liabilities. Okay? So, when I say working capital, it means current asset minus current liability results in working capital. Working capital. Okay? Now, what is the objective of working capital? Very simple. To create a balance between liquidity and profitability. Okay? So you need to create a balance between liquidity and profitability. You cannot do something that promotes profitability at the expense of liquidity and vice versa. Like buying from supplier in bulk will affect liquidity but will promote profitability. That's not balance. Okay? So objective is to create a balance between liquidity and profitability. How to manage working capital? The management of working capital is divided into managing individual components of working capital and working capital ratios. So first, if I start with working capital ratios, through ratios, how can we manage? So we work out liquidity ratios, we work out operating cycle ratios. So when I say liquidity ratios, it includes, can you tell me please? Current ratio, quick ratio, sales turnover ratio. If I say operating cycle ratios, what it means? Raw material days, WIP days, finished goods days, receivable days, minus payable days. And through this, you work out cash operating cycle as well. COC, raw plus WIP plus finished goods plus receivables less payables is COC. So tell me, the more the COC, is it better for the company? No. More finance costs will be more cash will stuck in the cycle, hence more finance cost. Right? And through these ratios, you also determine the company problem of over trading. Over trading or over capitalization. Now, what is over trading? When you try to increase the business sales without proper support of working capital. Okay. And what is over capitalization? Where you make too much of investment in your assets, in your current assets. Okay. So these ratios does help you to determine the situations. Now, how to manage individual components, which includes inventory, receivables, payables, cash. So through these individual components, you manage the overall working capital. Having said that, let's look at the inventory management. The best way to determine the reorder quantity or the order size is through EOQ. Why? Because EOQ results in a situation that provides you lowest inventory cost by ensuring 2S rule. What is that? The sum of holding and ordering costs is lowest and both are same at EOQ. Balance. Holding costs, ordering costs are same. It's a midway, I would say. Okay. So EOQ determines the reorder quantity, creates a balance between holding and ordering cost. Okay. But one thing that can challenge EOQ is bulk, Mr. Hulk discount. Bulk discount, Mr. Hulk discount. So Mr. Bulk discount can hit EOQ. So what to do, how to take a decision is very simple. You compare the cost of inventory as per EOQ, that is purchase cost, ordering cost, holding cost of EOQ versus purchase cost, ordering cost, holding cost based on bulk discount. And whichever is lower, you opt for it. Alas. Are you with me, everyone? Say yes or no. We are understanding everything. So EOQ provides you lowest cost of inventory, but until and unless discount is not there. But if you have bulk discount, it's a clash between these two. Then comes receivables management. Company selling goods on credit. It is important for company to ensure they have proper system in place. A system through which they can assess the credit worthiness of the customer, a system through which they can set the credit limit, for the company. Okay? A system of collecting the overdue debts, a system through which they can monitor. Okay? So collection of overdue debt, which means when the amount is overdue, it requires to be paid. How can you approach the customers? By sending them reminders, by calling them, they won't pick the call, visiting their office, they might run away from there. You may stop the services to them. This can result in making the payment. You can file a case on them, or you may use external debt agencies. Now, if you opt for external debt agencies, so you have a very famous option available by the name of factoring. What-toring? Factoring. Okay? Factoring. Factoring. Right? Now, factoring is an option in which you hand over your debt collection process to a third company, and you also opt for factor finance from them. So they provide you the finance and they will take over your administration and debt collection process. Now, this either could be recourse based or non-recourse. If it is recourse based, bad debt is the responsibility of the company and it is cheaper. If it is non-recourse based, the bad debt is the responsibility of the factor, and it is expensive. Okay? Done? Done. So we will assess the option of using factoring by performing a cost versus benefit analysis. Done. But if you want to make your life easier, you don't want yourself to be in a condition of sending reminders, too many calls, personal visits, and using factoring, the better option at first is to offer them early payment discount, early settlement discount. So if you go with early settlement discount, my friends, you need to assess the option of this by looking at the benefit versus cost. Now, the basic thing is the cost of discount. If you opt for this, if you give them discount for making early payment and they opt for it, so you need to give them discount. Discount is a cost that will be compared against the benefit you get in the return. So what benefit will you enjoy in return? Can you tell me, everyone? Yes, we can. The benefit could be in form of finance cost saving. Finance cost would go down. Why? You will receive the payment early. You don't need bank overdraft anymore. So your finance cost would be saved. Okay, what else? Your bad debt might go down because of the attraction to get a discount they may pay you. And your debt collection process or administration cost would go down. So you will weigh the benefit with the cost to assess whether this is the case or not. Done? Clear? Done. You will compare this. Plus, you need to know the calculation of calculating annual cost of discount. Sometimes if you are giving discount, so the question might ask you, what is the cost of giving discount? What is the annual cost of giving discount? That you need to work out. Okay? And for that, there is a formula: percentage discount divided by net of discount plus 1 power 365, 12, 52 weeks divided by number of days, months, weeks, payment made earlier minus 1. But it depends whether it is effective discount you want to work out, okay, or not. Are you with me? All right. It's time for another question. Another question. I hope the revision is clear to all of you. And now we are moving towards Section A. Some important things to be discussed about Section A. We did Section B, we did Section C. It's now time to move towards Section A. Are you with me, everyone? All right. So what are the tips, first of all, for Section A? Very simple. Cover the whole syllabus, bhai. Very simple. Cover the whole syllabus. You can't leave things. You can't leave things. Okay? Number 2, because you can expect any question appearing in Section A. Then 3.6 minutes is the criteria to remember to solve each Section A single OT. But should I tell you how will you manage this average time? Because there are 15 OTs having a weightage of 30 marks. That needs to be done in 54 minutes. How to achieve this? Should I tell you? Say yes or no. Yes, you should. Okay. So the best way is solve easy OTs first. Easy OTs. What do you mean by easy OTs, mister? Nothing special, simple. Out of 15, minimum 4 will be the easy ones that you can quickly do it, yaar. Because those will take your less time and will give you more score. More score not, will give you scores. So if you do 4 questions quickly and the average time is 3.6 minutes per question, because those are easy ones, you won't take 3.6 minutes in that case. You will take less time. Maybe you will take 2 minutes per question, and that would be around 8 minutes and 8 marks. Wow, yaar, wow. 8 minutes, 8 marks. 1 minute for 1 mark. Wow. So this will allow you to focus on difficult OTs. Then this will allow you to ensure you take more time for the difficult ones, and eventually your average time will be 3.6 minutes per question, allowing you to complete in 54 minutes. Khalas. Don't put extra pressure on yourself that I have to complete, I should know each and every OT. No, it will not be the case. There are bouncer OTs. Alas, no problem. Leave it. Do you play cricket? No, just leave it. Just go down. Because you need 16 marks minimum to pass out of 30. 16 out of 30, yeah? Which means just 8 OTs you need to ensure should be correct. Only 8, yaar. 8 out of 15. In that, 4 are the easy ones. So easy to pass. Just understand my game. Just understand my smart paper solving technique. And that technique is very simple. Pass in section A, minimum marks at least you should target. Pass in every question of section B, 6, 6 and 6, which means 18 out of 13 section B. And in CRQs, minimum 20 you have to target out of 40, which means every CRQ minimum 10, which means easy numbers first. So if you manage to pass in section A, maybe just pass in section A by getting 16, just pass in section B by getting 18, just pass in section C by getting 20, you'll pass the paper. That's my objective, yaar. Bas you pass it, that's the most important thing. Failure is not good. Okay, done. Very nice. Now, make sure fill in the blanks, proper rounding off. Make sure questions where they say is or are. So there might be one statement that is correct, might be more than one statement that is correct. So you have to read it. And for the narrative OTs, theory-based OTs, read the distractors. Read the distractors. Filter out the wrong ones. Okay? Filter out the wrong ones. So now what I mean to say by filter out the wrong ones, yaar, what I mean by this, filter out the wrong ones. Very simple. Very simple. Filter out the wrong ones means that those statements that can never be the answer, throw them out. Throw them out. Throw them out. Okay? Throw them out. Right? If you throw them out, then the chance of passing will automatically be high. And you will get close to the one those are considered the answer. You will get close to the one that are considered the answer. Are you with me? Yes or no? Yes. So this is the technique that you have to apply. Okay? Done. So now it's time to move towards some important section A questions. And the question that I'm picking right now are the examiner report questions. Examiner report questions, and we'll see why examiner has mentioned these questions as important one, because people were struggling. So let's have a look. Okay. Here you go. Now these are certain famous questions mentioned by the examiner where people were struggling. Okay. So let's have a look. Why? 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 Let's have a look. Now, examiner report OT solutions, we will be just producing here. Let's see why these are the difficult ones. Okay. Number one, the first one. The company G, whose home currency is pound sterling. It is important for risk management questions where you figure out the home currency, okay? Has received an invoice from European supplier, right? The forecast annual rate in domestic economy is 5.2% per year. while the European annual inflation is forecast to be 2.8% per year, right? So the current spot rate is given to you and the invoice must be settled in 3 months' time. Now, these are the questions that examiner has mentioned that people are struggling or have struggled. Let's see why is that. What is so special about it? Okay. So let's see here. Now, what to do, guys? What to do? Number one, just a minute, please. Yeah. Now, the local currency, home currency is pound. Okay. You are given with the inflation rate of domestic economy and inflation rate of European. Okay. So euro is the foreign currency and pound is the local currency. Correct? Look at the rate. If local currency is in denominator, this is known as indirect quote. And when the quote is indirect, you know my hack. My hack is what? The rule is bus and we always divide. Okay? Done? Now let's see what they're asking. They're asking me to work out the expected spot rate. Now, which, which method basically helps you to work out or predict the spot rate? Sir, the method is known as purchase power parity theory. Okay? In purchase power parity theory, what is the formula? Future spot into 1 plus foreign currency inflation divided by 1 plus local currency inflation. Is that right? Okay. So I need 3 months forward, future spot rate. Okay. So spot rate is 1.18 multiplied by 1 plus foreign currency inflation rate. And foreign currency inflation rate is 2.8. But should we take 2.8 here? No. 2.8 is the annual rate. I need to prorate this by multiplying this with 3 over 12. Are you with me? Okay. The problem people do in the exam is they don't prorate it. Then 1 plus local currency inflation rate of 5.2%. Again 3 over 12. Now by this calculation, if you end up doing this calculation, so the answer that you will get is euro 1.173 per pound. Done. The biggest mistake people have done is not prorating it. Guys, are you with me? Say yes or no. So which option will we opt for? D. Done. Now this is, I don't know why people did struggle in this question. Not very sure about it. Next question. Okay. Another calculation. This is a fill in the blank question where Rounding off instructions are very important to be followed. A project's predicted cash flow gave a positive NPV of 35,000 at a discount rate of 7% and negative NPV of 25,000 at a discount rate of 11%. Huh? What is IRR to one decimal place? Now, what kind of question is this? They are asking you to work out IRR. Peanuts, walnuts, cashnuts, I don't know. What is the formula of IRR, yaar? Come on, tell me. Lower rate, 7 plus NPV at lower rate, 35,000. Positive. Positive. This is negative. Okay? Divided by positive NPV minus negative NPV or NPV at higher rate, okay, which is 25,000 into higher rate of 11 minus lower rate, you will get IRR. What is the answer of IRR? Come on, guys, can you tell me? The answer of IRR here to one decimal place, you need to work out one decimal place. Okay, let's have a look how many decimals are there first of all. 35 divided by 60 multiplied by 4 plus 7, 9.3333333333 is the answer. I just worked out for you people in terms of percentage, okay? Now, one decimal criteria. Those who opted for 9, wrong. Those who opted for 9.4, wrong. Because to one decimal place means you have to bring your answer till here. And the criteria is simple. If it is one decimal place, so one decimal you have to show. But the point is that decimal that you have to show will be shown as rounded up or rounded down. So for that, it's very simple. Look the other digits. It's 9.3333. So after the first decimal, all the three are less than 500 or maybe less than 5, I would say. Okay. So if these are less than 5, then round down, which is 9.3. If these would have been more than 5, then round up would have been the case. Just imagine if this would have been 9.37. So now to one decimal, because this is more than 5, so this would have been 9.4. 9.4. But because this is 9.33, so we'll keep this to 9.3 only. Anyone writing it 9 will lose the marks, 9.4 will lose the marks. Khalas. One mistake people may do is the decimal policy. The other mistake in this question that people do very commonly is they are not adding these two together, because it is minus minus plus, minus minus plus. I don't know why this is a hard question. I don't know. Majority didn't add these two together. Next, theory. Cyprus company is keen to use Islamic finance for funding. Okay, Islamic finance for funding. Islamic finance for funding. Right? Now, want to use Islamic finance for funding? Okay? Clear? The board wishes to form equity finance. Equity finance is what they want. And that is, okay, fine. Which does not entitle to capital provider to participate in the management of the company. So they need an equity Islamic source of finance where the finance provider should not participate in the day-to-day management, should not participate in the day-to-day management. Which options you have? Sukuk, Mudarba, Musharaka, Murabaha. Answer is simple D. Why? Mudarba is a source of finance in which Islamic bank provides you the finance. They are known as Rabbul Mal. They provide you the finance, but they don't participate in the management. They don't participate, and this is what the condition is. Don't participate. Okay? Don't participate. Because in Musharaka, they also provide the finance, but they participate. So this is not right. This is not the answer. In Murabaha, they do not provide you finance. In fact, they buy on your behalf and then sell you at a credit. This is also not correct. In Sukuk, they buy share of the asset and then share the income. This is not correct. So Mudarba is the answer. Again, this was one question where people messed up. I don't know why. All right? Okay. Then next. Question coming from financial management, environment, function are those where people are struggling again. Let's see. Which two government policies are consistent with objective of decreasing national economic growth? Which two objectives are consistent of government policy are considered when decreasing the economic growth? So if they want to decrease the economic growth, what are the two things they will do? What policies? Come on. Number one, increasing government expenditure, right? Decreasing interest rates, allowing domestic currency to appreciate, okay? Increasing taxation, reducing unemployment, reducing unemployment, okay? Think please, just 1 minute. Yeah. Okay, now, first, we will find out the distractors that can never be the answers to make our life simple. And it is clear there are two are the correct ones. Let's start the first one. Increasing government expenditure. Now, if government increase its expenditure more on infrastructure, providing facilities, so it's part of their fiscal policy, or I would say expansionary fiscal policy, where they want to expand and they want to improve the economic growth. So if they spend more, they are promoting expansionary policy and hence the national growth will increase. So this is not the answer. Can never be. It's an opposite thing that they are doing. Number two, decreasing interest rates. Now, if you decrease the interest rates, again borrowing will increase. And when borrowing will increase, So this will again increase the economic growth. People will borrow, they'll spend more, the economic growth will increase. So this is again contradicting with the objective of decreasing the economic growth. So this again can never be policy, because this is again promoting the growth. Khalas. Okay. Reducing unemployment is also common sense. Once you reduce unemployment, more people will have employment, the more they're gonna earn, right? And this will promote the economic growth. This will not decrease, because here the condition is decrease the economic growth. So once people will have employment, they'll spend more. Alas, can never be the answer. Now, all these three are actually increasing the growth. More employment, more growth. Reduce interest rates, more borrowing, more growth. More spending by the government, more growth. These are opposite to what they wanted to do. And if I remove the distractors from here, automatically I will have two statements left, and these the answer, and these are the answer. Smart technique to solve. Smart way to find out the answer. If that is possible, if you're confident about the other statements, use this technique and get close to the answer. This will reduce your chances of errors. Okay. Now the logical one. Once taxation increases, people will have to pay more tax, less amount they will left with to spend, and this will reduce the economic growth. Yes. More taxation affects spending, economic growth will go down. Correct one. Logical. Number two, allowing domestic currency to appreciate, the local currency to appreciate. Now, if local currency appreciates, what it does? If local currency appreciates, this means your exports and your imports. What impact will this have on your exports? If local currency appreciates, okay, so your import will become cheaper, because your local currency has appreciated, foreign currency has depreciated, so buying from outside would become cheaper, your imports will become cheaper, imports are cheaper, imported products will be cheaper, okay? Imported products demand will increase, okay? Now, your exports will be expensive. Your exports will be expensive. And once your export will be expensive for the others, like for foreign customers, so they won't buy much. And once they don't buy much, this will reduce the demand for domestic products. Okay? So this means domestic products demand will be reduced. Are you with me? Yes or no? Clear? So export will go down, import will go up, and thus affecting the economic growth. Because the local products demand will go down. Done? So yes, this is also promote the decreasing national growth, because your demand for local domestic goods and services is going down, because exports are becoming expensive. So answer is C and D. This is logical way to reach to the answer. If not, sometimes smart technique says find out the distractors, those that are never the answers, out of the box statements, filter them out, distractors, filter them out, you get close to the answer. And this is a smart way of getting the answer. I hope this is clear to all of you. I hope this entire webinar of 2 days was useful for you people in terms of your understanding, knowledge, and you did enjoy it. Guys, feedback. Was these 2 days useful for you in terms of revision? Yes or no? Did you learn the techniques for section C, B, and A? Come on, I need your Gen Z based feedbacks. Gen Z based feedback is emoji based feedbacks. Yeah, hearts, thumbs up, something like that. Yeah. Happy? So I am sure these 2 days must have been useful for you. So self-study students, now you can watch my March 26 webinars free available on YouTube channel. And those who will enroll in my revision camp, get into the camp, follow the plans. Very soon we'll be having our grand revision next week, and also the mock, debrief, everything. So make sure you do attend those. If you're part of the batch, you can do the enrollment. Please share your feedbacks, those who will watch in form of recording, in the comment section. I hope the 2 days of webinar did help you in terms of boosting up the confidence and will help you to pass as well. Yeah, the previous webinar links we'll be sharing in the group that you have to be part of, the free groups. For CRQ, yes, I think for NPV related theory would be related to the question. Yes. Okay. Yes, it will be a live mock, and with live invigilation, we'll mark it and give you the feedback as well. So thank you very much. Please share your feedback in the comment section, how useful these webinars were. Stay connected with me through free groups. Till the last day, I will be available for you. I'll be sharing all the important webinar material on those free groups for you. These handouts as well as all important things that I want to share with you till the last day. Be with me in the group. Stay blessed. If you want to join the group, you can contact the admissions. You can message me for the link as well. Take care.